deal flow. Our network is very extensive. We believe that there's power in numbers. So we usually invest alongside of NEA, Northbridge, Johnson & Johnson Development Corp., Medtronic, strategics, as well as some very big venture firms. We just participated in a $60 million Series C round. We're also taking the lead in a seed round with a company out of Israel that is looking for $250,000. But in all of our cases, we are looking to invest alongside of very good, savvy investors like us, who are like-minded, thinking for the long term, who can also do their own due diligence. So I think the key for any company looking to raise capital, there's a lot of cash available. The stock market has been very heady. People are looking to diversify their assets. The life sciences area for investment right now is, I think, very ripe. But you really have to be able to withstand the due diligence required, not just by Wyndham, but by a whole group of investors, each wanting to do their individual due diligence and assessment.
Yeah, what struck me in watching the presentations was, I think the large majority of the presenters were looking for $1 to $2 million in a seed stage round. And there is a lot of money chasing those early stage investments. And however, there are a ton of companies raising $750,000 to $2 million in a seed stage. And given how it's, over the last 10 years, how more cheaper, that's not the right, but it's become less expensive to start a company, there are a lot of options for early stage, even angel investors and early stage VCs. And I think what that's led to, or I know what that's led to, is this idea of a rolling seed round. So for both my clients and the portfolio, the companies that Scout looks at, a lot of times they'll see, we're raising $1 million in a seed stage round. But given the competition to raise money, the metrics you need and the data you need to show an investor, to show why it's worth it to put in $1 million, is that threshold has grown. So what we've seen a lot is, and what I help my clients a lot with, is saying, okay, we're ideally raising $1 million. Well, let's say we can only find 100,000. What are you going to use that 100,000 do to generate certain metrics or certain data points that can then bring on the next 200,000? So raising that seed round, that $1 million all at one time, is actually, from what I've seen, becoming more and more rare, just given the competition to raise that money. So I think if you are out raising a seed round, if you can find a way to, if you can find a highly committed angel investor who really believes in you, you can take $100,000 at a convertible note. Can you use that $100,000 to get to certain metric points and then raise another $200,000 with maybe another convertible note with a slightly higher valuation cap, so it's less diluted? So I think it's a long rambling way of saying there is a lot of money chasing early stage deals, but the competition, there's also a lot of competition to raise that money. And you have to game plan out, are there more creative ways to spend smaller amounts of money so I can get traction and get going and get my foot in the door, rather than, we need $1 million to hire 5 people and start to do this. Are there other ways to do that? I think that from my experience, that's what I've seen.
Right, absolutely. And James, I think you kind of bring us right into the next question for the investors, for the entrepreneurs here and people trying to do this. From an entrepreneurial standpoint, it's getting people's attention, getting them excited, which I think today is a big part of that, and then getting to due diligence, which is the real hard work of getting the investment locked down. But what are the best methods of companies to kind of tap into this capital market? Is it forums like this? Is there a more direct approach?
Yeah. The same companies presenting to the angels that are presenting to LICA. These are different forums for getting a company's potential and mission in front of many people. Just like the investing side isn't for the faint of heart, raising money is not for the faint of heart on the entrepreneurial side. So you have to be prepared to give 50 pitches to find one that raises the interest, and don't give up. It takes that, and every investor you see has a different profile, different motivations, different time horizons, different fields they're interested in, different expertise. So the expectation that every one of them is going to react the same way is wrong, and it's going to take time on the entrepreneurial side, just like it takes perseverance from the investor side. They're out there, and you have to go every contact, every networking thing you can find, every word of mouth. I know a friend who knows a friend who will get me an introduction. That's what it takes to make that list of 50 opportunities and hope that one of them clicks.
Right, yeah, no, the great message is persistence, perseverance. Yeah.
I would, so two things. One, to that point, a gentleman, Ben Horowitz of, well, not in life sciences, but Anderson Horowitz, wrote a book, a great book called The Hard Thing About Hard Things. And every entrepreneur and every CEO should read it. And it's an interesting message there because, of course, Ben Horowitz has both been a very successful entrepreneur and now he leads one of the most successful venture capital firms out there. But it's very different. As a CEO or an entrepreneur raising money, you don't care how many people say no. You have one goal, which is to get one person to say yes and believe in your idea. And that should be your focus and your goal. So you're not playing a distribution of, okay, I got a lot of people saying yes, saying no. You don't care. You're way out on the tail of that distribution, but you only need one person. So that's a good thing. I think the other thing you can do is, I know at least with smaller early stage venture capital firms, right, we don't have, Anderson Horowitz has 40 investment professionals. You're going to run into somebody there. The larger venture firms at NEA, they have a lot of investment professionals. You're going to run into people there. You're going to find people that like your story. In a smaller firm, there's a few of us doing deals, right? And we're looking and you're seeing a lot of deals, but there's also spaces that we're interested in. So that's sort of when you talk about disruptive science at Harris Group, there are areas that we think that we want to be invested in over the next 10 years, and that's what we're looking at. And when that aligns with what you're doing, you're going to see a tremendous amount of interest. When it doesn't, it just doesn't mean, it means that we don't see that story. You clearly are far brighter than we are. So, you're probably not going to find it in us. And the question I think is often interesting to ask is, who do you know that would be interested in that? Because we speak to a lot of other investors and VCs, and all the time we're looking for investors to invest in our deals as well. And if you talk to somebody and they're not interested in the same space you are, but they're interested in another space, and so you go, oh yes, you need to call so-and-so at Polaris, right? Because they're looking at deals in an area you're in right now. And so, again, you need a huge funnel of network base, but often asking the question, do you know people that are looking in the area that we're interested in starting our company? Investors, that's probably one of their best contacts in doing that.
You know what? That's an excellent point because people typically just dive into their pitch, and you should probably ask a few questions of these people out of courtesy. What are your investment criteria? What types of firms you go into? What are you looking for? And that will help you get through, persistently and pervasively as fast as you can to get to the right firm. Okay. Any further thoughts from James? It was pretty comprehensive there, I think. Okay, one specific question, and then before I get to my other topics, I want to turn it over to the room to make sure we get your thoughts. But are there any types of financing vehicles that you guys typically look for or use, or that are better than others? And then how does that play into valuations?
Most of the investment vehicles ultimately are C corps. And some companies organize as LLCs, and typically they have to reorganize the Cs before the Series A happens. So the physical vehicle is typically a C corp. You mean the instruments, kind of security?
Yeah. Which ones are mostly? And is there any preference for any ones from your perspective or from an entrepreneur's perspective?
It's very common to use convertible notes.
Right.
We tend to not do that. We would rather face up to valuation questions at an early stage and not leave our position open to what may happen out of our control. So we generally prefer not to do convertible notes, which is a very common thing for seed money, for early stage money. But we will usually move toward doing a full-blown Series A, even if it's a plain vanilla, really simple Series A. We'd rather deal with the upfront issues and have them behind us than be postponed.
We agree that we don't like notes either. We'd rather have you price your value with us. We think notes leave too much unknown out there. I don't think it's oftentimes fair to the entrepreneur. So we know that with early stage, you have almost no choice but to do notes, but we prefer not to at Wyndham.
Yeah, from working with my clients, regardless of the vehicle through which, make sure that you find somebody in your network who can explain, regardless of what vehicle it is, kind of what's going on. What is the cap table mean? What does it mean for my outcome in the operation of my company? I think that a lot of times people just say, oh, it's a convertible note because it's a convertible note. No, that's just what everybody does. But the vehicle through which you receive investment does affect, or I should say can affect, in a sometimes very significant way, the way that you operate the company can hamstring you in some certain ways too. So I'd say regardless of, any vehicle can work, it's very situation specific, but I think it's very important to put in the work. It probably takes an hour to find somebody in your network who can explain what the term sheet means, or what the note means, or what the what that preferred shares, what the 1x preference means, or whatever, and what it means to the operation of the actual physically operating your company. I think it's, regardless of vehicle, it's important to understand the upside downside.
All right, perfect. Actually, it's really important, I think, to have the expectations on both sides of this equation match up. So asking those questions, getting to as many people as possible, and making sure you match up what you're looking for early on, I think can save a lot of time in the process and get you to a good spot. Okay, so with that said, I think what